Something big just snapped in silver, and it happened fast. We're talking about a collapse from around $121 down to roughly $71 in a matter of days, and then, almost violently, a snapback that caught nearly everyone off guard. As of February 3rd, Western spot silver ripped nearly 12% in a single day, trading back near $90 an ounce. But here's what you probably missed. Shanghai never really broke below 95 to 100 during the chaos. That's not random. That's not sentiment. And both futures desks and physical dealers are now saying the same thing. This move wasn't about demand disappearing. Stay with me, because I'm going to show you what actually just happened, why it matters right now, and how you can spot this setup the next time before the rebound starts. If you're holding silver, if you're watching from the sidelines, or if you're trying to understand what just broke in this market, you're ahead of most people right now. Your job is to understand the mechanics, not just react to the price. Before I explain what caused this, let me teach you something most people never really internalize about leveraged markets. Price doesn't move purely on buyers and sellers of the thing itself. It moves on who's forced to act. Think of it like a crowded theater with narrow exits. As long as everyone's calm, it's fine. The place can be packed, doesn't matter. But when someone yells fire, margin hikes, volatility spikes, people don't exit politely. They rush. And when you're leveraged, you don't get to choose when you sell. The exchange chooses for you. That's the key idea you've got to understand here. This wasn't silver suddenly becoming unwanted. This was silver becoming unaffordable to hold with borrowed money. And there's a massive difference between those two things. When a market moves because people want out, that's a sentiment shift. When it moves because people are forced out, that's mechanical. One reflects changing beliefs about value. The other reflects changing ability to maintain positions. And the aftermath looks completely different depending on which one you're dealing with. So when you see a vertical drop followed by a violent snapback, your first question shouldn't be whether silver is done. Your first question should be, was this forced or voluntary? Because if it's forced, the pattern that follows is predictable. And I mean really predictable. We've seen this movie before, multiple times. If this is making sense, drop a comment and let me know you're following along, because we're about to go deeper into the actual sequence of events, and understanding this mechanic will change how you watch markets from here on out. You'll start seeing stress fractures before they break. You'll recognize when selling is exhausted versus when it's just beginning. And that edge, that pattern recognition, that's what separates people who panic from people who position. Now here's what's actually happening under the hood. Let me break down the sequence, because this is where the education really pays off. First, silver had been running hot. I'm talking about a crowded trade, heavily loaded with leveraged longs. Everybody and their brother was long silver on margin. When volatility spiked, the CME raised margin requirements. That's the trigger. And understand what that means in practice. When margins go up, traders have to post more cash immediately or liquidate. It's not a suggestion, it's a rule. So selling begins, not because they want to sell, but because they have to. That forced selling pushes price down. And when price drops, it triggers more margin calls, which forces more selling. That's the cascade. This is a mechanical loop. Price drops, margin calls hit, forced liquidation happens, price drops further, more margin calls, more forced liquidation. It feeds on itself. And here's what makes it so violent. The people selling aren't making informed decisions about value. They're responding to automatic risk management systems. They're getting liquidated by algorithms. They're dumping positions just to meet cash requirements. Value doesn't matter anymore. Survival matters. And when everyone's selling at the same time for the same reason, liquidity disappears. Bids evaporate. Price gaps lower. You get those wicks on the chart that look insane. $20, $30 moves in minutes. That's not organic price discovery. That's a forced liquidation event. But here's the part that should make you nervous if you're not paying attention. These rebounds don't come gently. The secondary confirmation came from the divergence you probably missed. Physical markets didn't collapse the same way. Shanghai stayed elevated. We're talking 95 to 100, while Western paper prices cratered down to 71. That spread, that gap between physical and paper, that's your signal that this is mechanical, not fundamental. Think about what that means. If silver was actually losing value, if demand was actually collapsing, why would physical markets in Shanghai hold firm? Why wouldn't dealers there panic too? Because they're not leveraged the same way. They're not facing margin calls. They're dealing in actual metal, not paper contracts. So while Western futures markets were imploding under forced liquidation, Shanghai was basically saying, yeah, we're not selling at those prices. That divergence is everything. It tells you the crash was structural, not fundamental. The asset didn't break. The system holding the asset broke. And once that forced selling exhausts itself, once all the leveraged longs have been flushed out, the pressure flips. Shorts start covering. Liquidity returns. Paper prices race back toward physical reality instead of dragging it lower. And that's exactly what we're seeing now. Western spot silver ripping back toward 90, closing that gap with Shanghai. This isn't some mysterious reversal. This is what happens when mechanical pressure releases. And here's what's wild about this. Once that forced selling is done, the rebound comes fast. Really fast. We're talking about 12% in a single day. Moves that leave people behind, because everyone who was watching the crash assumed it would keep going. Everyone who was waiting for lower prices to buy got frozen. They kept waiting for 70, for 60, for 50. And meanwhile, price rocketed back above 80 in hours. That's the nature of these reversals. They don't give you time to think. They don't wait for consensus. They happen when forced sellers are exhausted, and suddenly there's no more supply at those levels. Shorts who piled in near the lows get squeezed. Buyers who were waiting on the sidelines realize they missed it, and price just rips. This is why understanding the mechanics matters so much. If you're staring at a chart thinking silver is dying, you miss the actual story. But if you're watching margin requirements, watching physical versus paper spreads, watching liquidation volume, you see it coming. You see when forced selling is peaking. You see when the structure is about to flip, and that's when you can position instead of panic. This is the exact same playbook we've seen before. In 2011, silver didn't top because demand vanished. It topped after a margin cascade. The CME raised margins 5 times in 8 days, 5 times, and each time more leveraged longs got flushed out. Price went from nearly $50 to $33 in days. People thought it was over. They thought the bull market died. But then, it violently reversed. Not all the way back to 50, but enough to wreck the people who shorted the lows. Same mechanical pattern, forced liquidation, exhaustion, snapback. The people who understood what was happening bought the panic. The people who only watched price got destroyed on both sides. In March of 2020, we saw it again. Gold and silver sold off hard into the liquidity crunch. Everything sold off. Stocks, bonds, commodities, crypto. Nobody cared about fundamentals. Everyone needed cash. Margin calls everywhere. Silver dropped from $18 to $12 in 2 weeks, and once again, people assumed it was done. But what happened next? Silver exploded. Within months, it was at 30. Why? Because the forced liquidation ended, liquidity came back into the system, and fundamentals reasserted themselves. The people who bought $12 silver in March 2020 made a fortune. The people who sold $12 silver thinking it was going to 8 got crushed. Every time this pattern has appeared, the rebound looked impossible to anyone staring only at the crash. That's the lesson. When you're in the middle of a forced liquidation event, it feels like the world is ending. The price action is so violent, so relentless, that it seems like there's no bottom. But zoom out. Look at the larger story. Leverage breaks first, price follows, and then fundamentals reassert themselves. The asset doesn't care about margin calls. The asset has intrinsic demand, intrinsic supply dynamics. And once the leverage is cleared out, once the system resets, price gravitates back toward those fundamentals. This isn't hopium. This is pattern recognition. This is understanding that markets have structure, and that structure behaves predictably under stress. You don't need to be a genius to see this. You just need to know what to watch for. And when you start seeing physical markets hold while paper markets collapse, when you see forced liquidation volume spike and then suddenly dry up, when you see shorts pile in near the lows right before a reversal, you know exactly what's happening. You've seen this movie before. You know how it ends. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this still fail? Absolutely. If silver loses the mid-80s decisively, this rebound thesis weakens. If we see sustained selling pressure below 85, below 80, that would tell us something changed. That would tell us maybe the fundamentals did shift, or that there's another wave of forced liquidation coming. If global liquidity dries up again, paper markets can overshoot downside longer than anyone expects. We saw it in 2020. We saw it in 2008. Liquidity crunches can break everything, even assets with strong fundamentals. So you can't just assume this bounce holds. You have to watch it. You have to let the market prove itself. And here's the thing about manipulation claims. Markets don't need villains to move violently. Structure alone can do that. You don't need some shadowy cabal orchestrating every crash. You just need leverage, margin requirements, and forced liquidation mechanics. Those ingredients alone create chaos. Now, could there be actors taking advantage of that chaos? Maybe. Could there be entities that understand these patterns and position accordingly? Probably. But it doesn't actually matter whether this was orchestrated or organic. The mechanics are what matter. The outcome is what matters. So instead of arguing motives, instead of debating whether this was manipulation or natural market action, focus on what you can control. Watch levels. Watch spreads between physical and paper. Watch whether rebounds hold, not just whether they spike. because the market will tell you what's real and what's not. Price is the ultimate truth. If this rebound holds, if silver reclaims 95 to 100 and closes that gap with Shanghai, that's confirmation. If it fails, if it rolls over and breaks below 75, that's information too. Either way, you're learning something actionable. There are probably three types of people watching this right now. The first is the shaken holder. You rode the run-up, you watched silver climb past 100, past 110, maybe past 120. You felt smart, you felt vindicated, and then the crash happened. You watched your gains evaporate in days. You survived the drop, but barely. And now you're watching this bounce thinking, is this my exit? Should I sell into this strength and just be done with it? That's a fair question. And here's my honest take for you. Your job isn't to predict 150 tomorrow. Your job isn't to call the top or the bottom. Your job is to decide whether the structure that broke has actually healed. Are we seeing forced liquidation end, or are we seeing a dead cat bounce before another leg down? If physical markets are holding, if Shanghai maintains parity near 95 to 100, if Western paper prices are converging back toward physical reality, that tells you forced selling is done. That tells you this wasn't a fundamental collapse. But if this bounce stalls out, if we can't reclaim those levels, then yeah, maybe this is your chance to reduce risk and walk away with something. There's no shame in that. Preservation matters. The second type is the sidelined skeptic. You missed the whole thing. You watched silver run from 30 to 100 and you didn't buy. You watched it crash to 71 and you still didn't buy. And now you're watching this bounce thinking, this feels like a dead cat. This feels like a trap. And you know what? You might be right, but here's the thing. Patience is power for you. You don't have to buy the bounce. You can wait for confirmation. Let price prove itself by reclaiming Shanghai parity near 95 to 100. Let it hold those levels for days, not hours. Let the market show you that forced selling is actually done and that fundamentals are reasserting. If that happens, you're not getting the absolute low, but you're also not catching a falling knife. You're buying confirmation instead of hope, and that's a legitimate strategy. The mistake would be sitting on your hands through the entire next leg up because you're still waiting for $60 silver that never comes. So watch the levels, be patient, but don't be so skeptical that you miss the move entirely. The third type is the momentum trader who smells blood in a good way. You don't care about long-term fundamentals. You care about setups. You care about volatility. You care about fast moves. And this environment is tailor-made for you. But here's your edge. Respect invalidation. If silver breaks below 70 to 75, this entire thesis changes. That would tell us forced liquidation isn't done. That would tell us there's another wave coming. So you can trade the bounce, you can ride momentum higher, but you need a line in the sand. You need a stop. You need a level where you admit you're wrong and you get out. That discipline is what keeps momentum traders alive. And if you have that discipline, this kind of volatility is where you make your year. Different styles, different time frames, same principle. Let the market confirm before you fully commit. Don't front-run hope. Trade what is, not what you wish. So here's what I want you to answer in the comments. Which of those three describes you? Are you the shaken holder trying to decide if this is your exit? Are you the sideline skeptic waiting for confirmation? Or are you the momentum trader looking for the next setup? Let me know, because understanding where you are in this market will help you make better decisions moving forward. Here's where I stand. I'm not euphoric and I'm not dismissive. I'm attentive. Let me tell you what I'm personally watching. First, I'm watching whether 85 to 90 holds as a launch zone. If price can consolidate here, if it can hold these levels for days without collapsing back towards 70, that tells me forced selling is truly done. That tells me the structure has healed. If it breaks, if we see another flush down, then we're not done yet. Second, I'm watching the gap with Shanghai. Reclaiming that parity, closing that spread between physical and paper, that's confirmation that Western paper markets have realigned with physical reality. That's the signal that this wasn't just a bounce, it's a reset. As long as that gap exists, we're still in structural imbalance. But once it closes, once paper and physical converge, that's when you know the market has healed. Third, I'm monitoring 70 to 75 as the line in the sand. If we break below that decisively, this entire rebound thesis changes. That would tell us something fundamental shifted, or that there's another wave of liquidation coming that we didn't see. So I'm watching those levels closely. I'm not guessing. I'm waiting for the market to tell me what's real. Based on my analysis, this crash was mechanical, not emotional. The fundamental picture didn't break. It waited. Silver didn't lose its demand profile. It didn't lose its supply constraints. It didn't lose its role in the energy transition or its monetary properties. What broke was the ability of leveraged traders to hold positions during a volatility spike. That's structural, that's temporary. And once that pressure releases, fundamentals come back into focus. We're seeing that now with the snapback. We're seeing physical markets hold firm while paper prices recover. We're seeing shorts cover. We're seeing buyers re-enter. This is what a post-liquidation environment looks like. Now, does that mean silver goes straight back to 120? No. Does it mean we're guaranteed to make new highs? No. But it does mean the crash wasn't what most people think it was. It wasn't a fundamental rejection. It was a leverage purge. And if history rhymes, if this pattern plays out like it has before, the move that follows could be substantial. Not because I'm predicting it, because that's what happens when forced selling ends and fundamentals reassert themselves. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at the CME margin requirements. Look at Shanghai premiums. Look at liquidation volume. Don't take my word for it. Make your own informed decisions based on your own risk tolerance and your own analysis. But if you made it this far, you're the kind of person who thinks critically. You're the kind of person who wants to understand mechanics, not just react to headlines. And that mentality will serve you well. That's the edge. That's what separates people who survive volatility from people who get destroyed by it. If this analysis helped you see something you missed, share this video. Get it in front of people who need to understand what just happened. Subscribe if you want more breakdowns like this, because we're living through unprecedented market conditions, and understanding the patterns matters more than ever. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.